I don't pay any attention to what economists say, frankly. Well, think about it. I mean, you have all of these economists with 160 IQs that spend their life studying it. Can you name me one super wealthy economist that's ever made money out of securities?
Today there's a lot of talk of a stock market crash, and every thumbnail has Cathie Wood literally on fire or a terrified facial expression, or both. And personally, I think this can scare a lot of new investors into making poor decisions, and finance creators on this platform should really be doing the opposite of that in my opinion, but that's a different topic entirely. There's a lot of talk of inflation, interest rates rising, treasury yields, a lot of macroeconomics. Everyone is talking about a crash due to several of these macroeconomic factors, but one of, if not the greatest investor of all time, does not listen to economists or economic forecasts. In fact, when selecting companies to add to the Berkshire Hathaway portfolio, Warren Buffett said he will, quote, never make an acquisition based on macro factors. Now, what I personally think Buffett is saying here from this interview in 2016 is that it's pretty much impossible to accurately predict the economy 100% of the time. So instead, try to predict things that are perhaps more easily predictable, like the expected productivity of a consistent, good business. This article continues saying that those macroeconomic factors have no impact on Buffett's decision making because, as Buffett puts it, we know we don't know. We know forecasting economic trends is not a sustainable long-term strategy. Just take a look at this quote. We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, two oil shocks, the resignation of our president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bill yields fluctuating between 2.8 and 17.4%. In other words, just buy good companies at good valuations and you will do fine in the long term. The buzzwords these days are interest rates, bond yield, and inflation, but odds are most of us will not become macroeconomic experts in the next 2 to 4 weeks to be able to make an accurate prediction for ourselves on where the stock market is going. Because that's pretty much what the market is reacting to right now. Predictions for higher interest rates, higher inflation, and yes, currently rising bond yields. But as Buffett says in this video that we'll watch today, not even professional economists know what will happen most of the time. In this video, my goal is really just to provide some level-headed thoughts and remind you not to get too emotional when your feed might be flooded with stock market crash videos. Because actually, as of right now, there really is no crash, and I'll prove it to you. Since February 16th, which is about the recent top from the Nasdaq, it has officially entered correction territory after a 10% drawdown from recent highs. Obviously, that's not ideal, but a correction is not a crash. There's a reason we have two different terms. A crash does not discriminate. It's often caused by fear, panic, and uncertainty, like the Rona. And today, selling algorithms have made crashes fast, swift, and sweeping. But guess what? Texas Roadhouse is up since February 16th. Banks like Charles Schwab, Wells Fargo, JP Morgan, Citi, they're all up. And that does have to do a bit with macro. But recovery plays like Wynn are up. Cake and Dan the Man, two stocks I used to own, are up. This is not what a crash looks like. It feels like a crash because many investors, myself included, have been holding high growth, high flying stocks that were in desperate need of a valuation reset. And now I think the market is simply reminding us that, hey, valuations do still matter. So, Cathie Wood's stock market crash is another common kind of clickbait title, which adds to the echo chamber of fear, which again is totally the opposite of what I think creators should be doing, but that's just my opinion. In these videos, she speaks about an extended correction, not a crash, and she called this valuation reset on high flyers.
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course.
And that's pretty much what's happening. And I personally think long-term investors should really like what's happening right now with this valuation reset for two big reasons. One, it's healthy. We can't have stocks going up 5 to 10% every single day forever, because if that happens, then this happens. We have stocks dropping 30, 50%, and they could still be overvalued. There are some stocks out there that could drop another 20% and still be really expensive. This is actually kind of why over the past year, I haven't added too heavily to a lot of the growth stocks that I bought a long time ago. And the second reason why long-term investors should enjoy this price action is because it lets us buy good companies at better, more reasonable prices. Sometimes I do need to remind myself that I'm buying a business, not just a ticker symbol or a stock on a screen. And while there are still some companies that are a bit expensive right now, we're starting to see them come back to earth and some deals arise. Anyways, I wanted to put this video together because I feel like retail investors might be getting a bit emotional when every day their feed looks like this. And from personal experience, I find that fear, emotion, doubt, that often stems from a lack of conviction or understanding in something. So if I was someone who is newer to the market and I don't yet understand the complexities of macroeconomics, then this can definitely be a worrisome time. And you hear all of these complex relationships and fancy macroeconomic and finance terms, and you feel like you have to act on it somehow. But how can I act on something if I don't fully understand it yet? So what are some options as to what you could do instead? Well, first, let's go back to the Buffett video and see what he has to say about an economist named John Maynard Keynes. Because if he's an economist, then he can probably predict market cycles better than anyone.
I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple of times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well.
So when a professional economist made economic projections and tried to trade stocks based on those forecasts, he went broke. Let's watch that last part of the video again.
To borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
So Keynes switched to buying good businesses at cheap valuations, and he ended up doing a lot better. And then at the end of the video, Buffett says something kind of funny. He says economists don't often make much from trading and buying stocks, but people who trade and buy stocks listen to economists. I just thought that was kind of a funny comment, but the point of this video is to say, hey, let's take emotion and fear out of everything and just look at these businesses individually. Personally, I would ask myself, okay, are we in a market crash? No, there's a rotation to other sectors. Some stocks don't even look like they've been affected. The whole market is not crashing, okay? What's causing this downturn, and does it affect my stocks or my businesses on a fundamental level? No? Alright, let's look at the valuation. Is it trading at a fair price, overpriced, or undervalued compared to historical levels? It was trading cheap compared to historical levels, so then what is stopping me from buying more of this stock? Now, there's a couple things I want to make very clear about this video. Right now, there is no crash, at least in my opinion. But that doesn't mean there won't be, because no one can predict that sort of stuff. But right now, if we look at it as it is, the SPY and Dow are really barely down from their recent highs, and the Nasdaq just entered into correction territory, and we have a lot of stocks in the green over this past month. And trust me, my portfolio is definitely hurting, and it feels like a crash if you just look at my portfolio, but I know value investors who don't even look like their portfolio has been affected, and they're actually doing quite well right now. In a real crash, everyone's portfolio would be hurting. And the second thing I want to make clear is that I'm definitely not saying you should completely disregard macroeconomics and stick your head in the sand. That is probably not the right way to go either. In fact, I think a good grasp of general macro is very important in understanding the market as a whole and can give investors a big picture view. For example, if you had a really good understanding of macro and the Fed and their operations, then you probably could have almost timed the exact bottom last year in March when the Fed stepped in and kind of saved the day. What I am saying is that trying to learn all of this in the next 2 to 4 weeks and become an expert and then make a decision based on those predictions, personally, I think that may lead to some poor decision making. At the end of the day, you have to find what kind of balance and investing style works for you, makes you happy, and lets you sleep at night. I just wanted to add some value and a new perspective to the conversation and try not to just say what tens of others have already said. So I hope you found this video at least a bit helpful or refreshing, and I know it's not the most fun time to be a growth investor, but that's kind of the trade-off we make. If we want to really outperform, we're probably also going to really underperform when times are like this. So if you don't really like the volatility going on in your portfolio right now, this is a great learning opportunity to see what kind of style you like in terms of risk reward, risk tolerance, diversity by sector, and all of that stuff. I've definitely been learning a lot these past few weeks in terms of portfolio diversification, the essence of value investing, why it's still very relevant today, risk reward, and all that good stuff. And I suggest everyone keep an investing journal. Just write about your feelings, what you're learning in times like these, because this is where the real lessons come to light. And I'll leave you with this food for thought. When things are good and stocks are going to the moon, many say value investing is dead. But in times like this, when portfolios are red, who do we all end up quoting and listening to? Warren Buffett, the ultimate value investor. That might be weird to hear from someone who has been mainly a growth investor for most of my investing lifetime, but I'm always trying to tweak my strategy, improve it, and learn what really works over the long term. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.